What if the single greatest threat to your retirement security isn't a market crash or a soaring tax bill, but a health expense most people never see coming until it's too late? You've saved, diligently built a cushion, even bought what you thought was comprehensive insurance, all with the belief that you're protected against medical emergencies. But there's one cost that falls almost entirely on your shoulders: long-term care, and it can blow through six-figure savings in just a few years, leaving you scrambling for help. Imagine moving into a nursing facility that charges $8,000 to $10,000 a month for basic custodial care. Help with bathing, dressing, meals, services your standard Medicare plan doesn't cover. Picture the sticker shock when home health aides bill $25 to $40 an hour for the simple tasks you once handled yourself. Consider a spouse struggling to care for you at home, sacrificing their own income and health in the process. This isn't a worst-case scenario. It's the reality for nearly 70% of retirees who need some form of long-term care. And the duration? It can stretch 5, 7, even 10 years if you develop chronic conditions or memory loss. Most long-term care insurance policies either come with premiums so steep they drain your cash flow, or benefit triggers so restrictive that claims get denied when you need them most. If you try to qualify for Medicaid, you'll often have to spend down your assets to almost nothing and navigate onerous look-back rules. And even then, your estate could face clawbacks after you're gone. Meanwhile, every ramp you install, every caregiver you hire, even a few hours of adult daycare, adds up into the tens of thousands. And when children step in, they're often forced to choose between their own mortgage payments and helping cover your bills, creating stress and financial strain for the whole family. In this video, we're exposing the 7 hidden facets of long-term care costs that can shatter your budget without warning, and showing you how to spot the dangers before your nest egg disappears. Stay tuned, because knowing this one expense could mean the difference between a golden retirement and an unintended dependency you never planned for. Most retirees assume Medicare will swoop in to cover every medical bill, but there's a massive coverage gap that catches thousands off guard every year. Medicare Part A handles hospital stays, and Part B steps in for doctor visits and outpatient services, but neither covers custodial care, the basic help with bathing, dressing, eating, or using the restroom that many seniors need as they age. After a 3-day inpatient stay, Medicare will only pay for up to 100 days of skilled nursing facility care, and only if you require skilled therapy each day. Once that window closes, or if you never meet the skilled threshold to begin with, you're responsible for every dime of custodial services. That means a nursing home charging $8,000 a month for room and board, or home health aides billing $30 to $40 an hour to help you get dressed, feed you, or remind you to take medications. It's the kind of basic support you might imagine Medicare would cover automatically, but it doesn't. Seniors can go from thinking they're fully insured to facing six-figure bills in just a few short years. And because these expenses aren't lump sum events, but ongoing charges, they compound rapidly. You might manage the first few months by dipping into a cushion, only to realize a year later that your entire nest egg has been cut in half. What makes this gap even more dangerous is the lack of upfront warnings. No letter from Medicare outlines your custodial care liability. No agent points out the months-long coverage cliff. The reality often hits with a nursing facility invoice or a stack of aid bills, and by then it's too late to adjust. If you believed you were protected under Medicare, you've likely already faced a financial horror story quietly brewing beneath the surface. And while this discovery can feel like a death sentence for your savings, it's only the beginning of a series of surprises that can shatter your retirement budget without warning. One of the most insidious threats in long-term care is not just how expensive it is per month, but how wildly unpredictable its duration can be. And that unpredictability can turn a manageable bill into financial ruin. On average, a stay in a nursing facility lasts around 2 to 3 years, but that average hides a wide range. Nearly 20% of people will need care for 5 years or more, and a significant minority will require assistance for a decade or longer if they face chronic illnesses or dementia. Multiply even a modest $8,000 a month facility cost over 5 years, and you're looking at nearly $500,000. Stretch that to 7 or 8 years, and you can easily exceed $750,000 before you even factor in inflation or extra medical expenses. And if you're trying to age in place, the story isn't much better. Home health aides billing $30 to $40 an hour. 3 visits a day adds up to well over $3,000 a month. And it's the rare caregiver who can sustain that schedule for years without raising rates or burning out. Because retiree budgets typically plan for a fixed horizon, say 5 years of care, those tail risk cases get overlooked until they hit. Families scratch their heads as costs spiral, tapping into every reserve and even selling the family home just to keep the bills paid. The fear of outlasting your savings becomes very real when care extends past the expected timeline, and there's no insurance policy that covers unlimited duration at today's rates. What makes duration risk especially treacherous is that you can't hedge against it. You don't know in advance who will recover quickly and who will need long-term support. So, as you budget for care, you're effectively gambling on your own health trajectory. A bet that far too many retirees lose, leaving a perfectly planned retirement budget shattered by the time the real duration of their care need is revealed. Many retirees turn to long-term care insurance as the solution to cover hefty custodial care costs, only to discover the hard way that policies can be riddled with caveats and exclusions that leave them stranded when they need help most. First, premiums for new buyers have soared as insurers adjust to rising claim rates, meaning a healthy 65-year-old might pay $3,000 to $5,000 annually for a policy with a modest daily benefit of $150 to $200. That's a steep price on a fixed budget, and those premiums typically increase over time. Next, underwriting hurdles can disqualify people with even minor health issues. A history of high blood pressure, mild cognitive decline, or mobility challenges can lead to outright denials or a policy loaded with exclusions that render coverage nearly useless. But even if you clear underwriting and commit to escalating premiums, you're not in the clear. Most LTC policies include elimination periods, waiting days before benefits kick in, often 60 to 90 days, during which you're still on the hook for every expense. If you need care for less than a few months, you might never see a dime. Then come inflation riders, which sound prudent, guaranteeing that your daily benefit keeps pace with rising costs, but tack on additional 3 to 5% premium hikes each year, multiplying your outlay, and sometimes costing more than the base policy itself over a decade. Benefit caps and maximum payout periods further complicate matters. Many policies cover just 2 to 3 years of care at most, leaving any additional months entirely out of pocket. And hidden clauses, like requiring you to be unable to perform 2 or more activities of daily living, can delay your claim approval until your condition severely deteriorates. By the time you navigate claim forms, provider assessments, and insurer reviews, you may have already depleted significant savings or face a denied claim, forcing you back to square one. In essence, long-term care insurance can feel like buying a safety net woven with holes. And when those holes appear, they threaten to shatter the financial security you thought was guaranteed. Qualifying for Medicaid might sound like a last resort lifeline for covering long-term care, but its asset spend-down rules can turn your safety net into a trap that strips you of nearly everything you've saved. To be eligible, you must reduce countable assets to almost zero, typically down to $2,000 for an individual by spending down on care costs, home repairs, or even questionable transfers that can trigger penalties. Those penalties aren't minor fines. Medicaid enforces a look-back period, often 5 years, during which any gifts or transfers for less than fair market value incur a penalty equal to weeks or months of ineligibility. That means giving your child $50,000 today could result in a 6-month period later when Medicaid won't pay a dime, leaving you on the hook for every bill during that blackout. Even legitimate spend-down choices come with their own pitfalls. Paying off your mortgage might sound smart, but once you own a home outright, it becomes an exempt asset only if you live there. If you move or need to sell, the proceeds count against you. Prepaying funeral expenses, purchasing a new vehicle, or drafting irrevocable burial trusts are common strategies. Yet each carries strict rules about timing and documentation. A misplaced receipt or an out-of-window purchase can cost you critical months of coverage. And once Medicaid steps in, state recovery programs can pursue reimbursement from your estate for payments made on your behalf, meaning your heirs could inherit a claim on your home or other property. In other words, you're forced to sacrifice your financial legacy or risk gaps in care just to get the coverage you need. For retirees who thought Medicaid would protect both their care needs and their family's inheritance, the reality is brutal. Navigating spend-down and look-back rules is a high-stakes game that can shatter your budget and leave you with nothing but complex legal battles and unexpected bills when you thought you were finally covered. Retirees determined to age in place often underestimate how quickly home modifications and in-home support services can rack up expenses that chip away at even the most carefully saved nest egg. Sure, installing a simple wheelchair ramp might cost $2,000 to $5,000 and bathroom grab bars another few $100s, but when you factor in full bathroom remodels to widen doorways or replace tubs with roll-in showers, the price tag can soar into the tens of thousands. Then come ongoing costs. Licensed home health aides charge $25 to $40 an hour for assistance with daily tasks such as bathing, meal preparation, medication reminders, and light housekeeping. A modest schedule of 3-4-hour visits per week adds up to nearly $15,000 a year. And if your needs escalate to daily care, you're quickly looking at $60,000 or more annually, numbers that make even a skilled nursing facility seem relatively affordable by comparison. Beyond direct care, there are other hidden expenses. Increased utility bills from medical equipment, maintenance costs for specialized lifts or stair glides, and higher homeowners insurance premiums to cover modifications and liability. Families must also budget for emergency alert systems and regular professional assessments to ensure the home remains safe as needs evolve, each assessment carrying its own fee. Many retirees plan for a one-time expense, only to discover that as their health declines, they must reinvest in new technologies or expanded services. Yet, those upgrades come at full market rates with no bulk discounts or insurance coverage. Even volunteer-based or nonprofit programs intended to offer low-cost assistance often have strict eligibility criteria or limited availability, leaving gaps that must be filled by private providers. As these mounting charges quietly deplete savings, retirees find themselves forced to cut other essentials or ask their children for financial help, transforming a strategy meant to preserve independence into the very reason they lose it. Without a clear budget and contingency plan for home-based care costs, the dream of staying in your own home can become a financial burden so heavy it shatters the retirement security you worked a lifetime to build. When professional care becomes unaffordable or unavailable, many retirees turn to family members for help, believing that love and proximity will fill the gap. Yet, the true cost of family caregiving is staggering, and it often falls entirely on your children's shoulders rather than your own budget. Imagine your daughter reducing her work hours or quitting her job to drive you to appointments, manage medications, and prepare meals. That lost income can tally $30,000 or more per year in wages alone, not counting the hit to her retirement contributions, Social Security credits, or health insurance premiums she might lose. Then there are out-of-pocket expenses. Your caregiver's mileage reimbursements, extra groceries, home utility spikes from hosting your care, and even costs for private training or certifications your family member pursues to do the job safely. Burnout is another hidden toll. Caregivers often face stress-related health issues, from chronic fatigue and depression to elevated blood pressure, leading to medical bills that further strain family finances. And when siblings disagree on the division of responsibilities or compensation, relationships can fracture, adding legal or counseling costs that rarely show up in the initial caregiving plan. Even free family care carries an opportunity cost. Every hour spent caring is an hour of lost career advancement, educational pursuits, or time with grandchildren. Over a decade, these cumulative effects can far exceed what you'd pay a professional aide. And yet, family caregivers rarely receive adequate support or reimbursement. When those hidden costs hit your children's wallets and well-being, They may feel forced to ask you for financial assistance, creating a painful role reversal that chips away at both your independence and their stability. Relying on family for care may seem noble, but without a clear compensation plan and external support, it can become the hidden expense that crumbles your retirement dreams and your family's harmony without warning. Medicaid isn't just about covering your care costs while you're alive. It often reaches into your estate after you're gone, leaving heirs with the unwelcome task of repaying every dollar the state spent on your behalf. Known as Medicaid estate recovery, this program varies by state, but typically targets the value of your home, bank accounts, and other non-exempt assets once your spouse or dependent children are no longer living in it. Many retirees assume that by the time they die, their children will inherit the family home or a modest nest egg, but instead, they find a lien on the property or a bill demanding reimbursement for years of nursing home stays. Even if you thought you'd protected your assets by placing them in irrevocable trusts or gifting them while you were alive, any transfers made within the Medicaid look-back period, usually 5 years, can trigger penalties that delay eligibility or result in clawback claims. That means a carefully planned gift to your favorite grandchild could backfire, costing your estate a penalty period equivalent to weeks or months of uncovered care. Worse, because recovery programs can continue for decades, your heirs may face legal bills and court battles defending exemptions or disputing valuations, all while the recovery clock ticks on unpaid liens. And if your state's program includes a post-death recovery period, even assets you thought were beyond reach, like proceeds from life insurance policies paid to your estate, can be redirected to satisfy debts. What was meant to ensure you received the care you needed ends up erasing the legacy you intended to leave. These estate recovery rules are rarely discussed at the time of application, buried in fine print notices and glossed over by well-meaning social workers. Families often discover the truth only after receiving a demand letter years down the line, when wills must be probated and assets liquidated under court order. For retirees who dreamed of passing on a home or savings, this final hidden expense can feel like the cruelest, snatching away everything you've worked for just when you thought your family would benefit most. Retirement should be the time when you finally enjoy the freedom you've earned, not the moment you find out that a single unanticipated health expense can rip through your savings and leave your family scrambling. By now, you've seen how Medicare's coverage gaps force you to pay for basic custodial care that balloons into six figures, how the actual duration of long-term care often far exceeds average estimates, and why insurance policies can fail you through high premiums, restrictive triggers, and limited benefit periods. You've learned that qualifying for Medicaid can mean spending down nearly every dollar of your assets and still risking estate recovery claims that haunt your heirs, while upgrades to age in place, ramps, lifts, aids pile on persistent out-of-pocket bills. You've seen the real cost of relying on loved ones for care, from lost wages to health impacts, and how every hour they spend helping you translates into financial and emotional burdens. And if you thought those were the final nails in the coffin, you now know that after you're gone, your estate may still be chased by states demanding reimbursement for the very care you received. Each of these 7 hidden facets of long-term care isn't just a statistic on a brochure. It's a potential poison pill for your retirement plan and a ripple of stress for the people you love most. The good news is that awareness gives you power. You can explore hybrid insurance options with more flexible triggers, set up asset protection strategies before look-back periods begin, build dedicated care reserves separate from your day-to-day nest egg, and have honest conversations with your children about caregiving roles and compensation. You can also consult advisors who specialize in elder law and care planning, so you're not blindsided by fine print or state recovery rules. Because in the end, the best way to safeguard your independence and preserve your legacy is not to hope for the best, but to plan for these worst-case scenarios now. That way, you'll spend your retirement on your terms, not on a scramble to cover bills that could have been anticipated, and avoid the unintended burden of forcing your children into a financial or emotional crisis they never signed up for.